Imagine walking into a bank and saying, "Hello, my company lost over $4 billion last quarter. Can I please have one of the highest company valuations in human history?" Normally, they would politely escort you out of the building. But in 2026, investors might actually throw money at you because this is SpaceX, Elon Musk's rocket, satellite and AI empire, and it is preparing to go public in what could be the biggest stock market debut in human history. Today, we will explain 4 things. Number 1. What an IPO actually is. Number 2. How a company losing billions can still be worth almost $2 trillion. Number 3. Why investors are excited anyway. And number 4. What the accounting numbers actually tell us. Let's start with what SpaceX actually does. Before we talk accounting, we need to understand the business. SpaceX has 3 giant operations. First, rocket launches. SpaceX launches satellites, astronauts, military equipment and cargo into space. Governments and private companies pay SpaceX billions of dollars for these launches. In fact, SpaceX is now so dominant in this market that it handles more launches than any other company on Earth. Second, Starlink. Starlink uses thousands of satellites orbiting Earth to provide internet access to anyone, anywhere in the world, from remote villages in Africa to ships in the middle of the ocean. And third, Starship and Mars, the long game, making humanity multiplanetary with Starship missions to Mars. And here is why investors love Starlink. Customers pay a monthly subscription every single month, predictably, forever. In accounting, we call this recurring revenue. And recurring revenue is like music to an investor's ears, because it is stable, predictable, and grows over time. Starlink has already crossed over 4 million subscribers worldwide, and that number is growing fast. Now let's simplify the IPO. IPO stands for Initial Public Offering. This is the moment when a private company opens its doors to the public stock market and lets ordinary people buy shares for the very first time. Before the IPO, only wealthy private investors, venture capital firms, and employees own shares. After the IPO, anyone, you, your neighbor, your grandmother, can buy a piece of the company. Companies do IPOs for 3 main reasons. 1. Raise enormous amounts of cash to fund expansion. 2. Grow faster than they could with private funding alone. 3. Allow early investors and employees to finally sell their shares and take profits. For SpaceX, the IPO filing on May 20, 2026 revealed plans to raise somewhere between $75 and $80 billion, which would shatter the previous world record of $29 billion set by Saudi Aramco back in 2019. A roadshow where company executives pitch to big investors is expected to begin around June 4th. Public trading could start as soon as mid-June. Now let's talk accounting. And don't worry, this is actually very simple. Every business on Earth can basically be explained using 3 numbers. First, revenue. This is money coming into the company. Every satellite subscription, every rocket launch, every government contract, that money becomes revenue. Second, expenses. This is money going out. Engineer salaries, factories, rocket fuel, launch sites, satellite production, research and development. And occasionally, a rocket turning itself into a very expensive firework during testing. Third, profit. This is what remains after the company pays all of its costs. The formula looks like this. Profit equals revenue minus expenses. If expenses are bigger than revenue, the company reports a loss. Now let's look at SpaceX's real Q1 2026 numbers from the public filing. Revenue $4.69 billion. Total costs and expenses $6.64 billion. Operating loss minus $1.49 billion. Net loss after interest and debt minus $4.27 billion. At first glance, some of those numbers look confusing, so let me explain them clearly. SpaceX generated almost $5 billion in just 3 months. That is an enormous business. But the company also spent $6.64 billion on operating costs during the same quarter, which gives us an operating loss of about $1.94 billion. So why does the headline say SpaceX lost $4.27 billion? Because there is a second layer. Interest payment on $29 billion in debt and other financial obligations below the operating line. That pushed the total net loss much higher. Now, here's the number that really explains the SpaceX story. On top of all those operating costs, SpaceX spent an additional $10.1 billion in capital expenditures during Q1 alone, with $7.72 billion of that going directly into AI infrastructure. And this is where accounting gets interesting. Capital expenditures are not the same as expenses. When a company buys a building or builds a data center or purchases thousands of GPUs, that money doesn't hit the income statement as a cost at all at once. Instead, it gets recorded as an asset on the balance sheet and gradually depreciated over time. So, the $7.72 billion in AI spending isn't fully captured in that $6.64 billion expense figure. It's a separate, long-term investment bet. In other words, SpaceX is spending at a pace where if this continues all year, they will invest more in infrastructure than the entire company generated in revenue last year. And this is the important part. Investors are not panicking because most of these losses come from aggressive long-term investment, AI infrastructure, Starship development, and expanding the Starlink network. SpaceX is behaving less like a normal company trying to maximize short-term profit and more like a company trying to build the infrastructure of the future as fast as possible. So the real investor question is not why are they losing money? The real question is, will all this spending eventually create something even bigger? Let me give you a simple example. Imagine you open one pizza restaurant. You spend a lot on rent, staff and equipment. In the first year, you probably lose money. But now imagine you open 1,000 pizza restaurants across the country in 1 year. You spend enormous amounts of cash. On paper, you look terrible. But investors might say, this person is building something massive. Once growth slows and the restaurants are established, the profits will be enormous. This is called growth investing. And it is exactly what happened with Amazon, Netflix and Tesla, all of which lost money for years before becoming some of the most valuable companies on earth. SpaceX is the same story. It is spending aggressively today to dominate tomorrow. Since the start of 2025, SpaceX spent $20.4 billion on AI infrastructure alone, building massive data centers in Memphis and Mississippi. This is not a sign of a failing company. That is a company betting everything on the future. Now we reach the craziest part of this story, valuation. Valuation simply means what investors think a company is worth. And this is extremely important. Valuation is not the same as what the company earns today. A company can make profit, lose profit, or barely survive, and still receive a gigantic valuation if investors believe future growth will be enormous. For SpaceX, investors are imagining global internet domination through Starlink, massive military and government contracts, leadership in AI computing infrastructure, and future space industries we cannot even imagine yet. Now, when a company is losing money, we cannot use traditional profit-based valuation. So investors use something called the price-to-sales ratio, or P/S ratio. It is simple. Instead of measuring profit, you measure revenue. Then you compare the company's total valuation to that revenue. P/S ratio equals company valuation divided by annual revenue. SpaceX's valuation of $1.75 trillion divided by its projected 2026 revenue of roughly $20 billion gives a P/S ratio of about 87. That is extremely high, but investors are paying for future dominance, not today's numbers. Here is an accounting concept that confuses almost everyone, including many professional investors. Profit and cash flow are not the same thing. Let me explain with a simple example. Imagine you spend $100 to buy a machine that earns $10 every single month. In year 1, you are down $100. You look terrible on paper, but here is the reality. By month 10, you have broken even, and from month 11 onwards, every single dollar that machine earns is pure profit. Forever. Now apply that logic to SpaceX. SpaceX is spending billions today to build satellite networks, AI data centers, and rocket infrastructure. On paper, the losses look alarming, but the cash flowing in from Starlink subscriptions is real, monthly and growing. The cash flowing in from launch contract is real and large, and the company has continued to attract investor funding precisely because the underlying cash business is strong. This is why experienced investors look at both numbers, not just accounting profit, because profit can be misleading for a fast-growing company. Cash flow tells you whether the business is actually surviving. Now, for the part that is making financial experts debate loudly. When you buy SpaceX shares, you will probably receive limited voting power. Normally, owning shares means you have a say in how the company is run. You vote on major decisions, board appointments, and strategy. But many modern tech companies, including Google, Meta, and now SpaceX, create multiple classes of shares. One class gets strong voting rights. Another class, usually the one sold to the public, gets much weaker voting rights. According to the IPO filing, Elon Musk currently holds 85% of the voting power in SpaceX. Even after the IPO, his voting share will stay above 50%, meaning he can appoint directors, block decisions, and essentially run the company however he wants. He cannot be fired, he cannot be outvoted. Supporters argue this is actually good. It protects SpaceX's ambitious long-term mission from short market pressure. Without this structure, Wall Street might force the company to stop spending on Mars missions and just maximize quarterly profits. Critics argue the opposite. Public investors are taking on enormous financial risk, but getting little actual control in return. You're funding the company, but Elon is making all the decisions. Both arguments are valid. And here is something important that very few people are talking about. Nasdaq recently changed its rule to allow SpaceX to join major stock indices almost immediately after the IPO. This means that passive index funds, which must automatically buy every company in the index, will be forced to purchase SpaceX shares. That includes many pension funds and retirement accounts around the world. People who never choose to invest in SpaceX could end up owning it automatically. So why do investors still line up to buy companies like this? The honest answer is because modern investing is driven by narratives just as much as numbers. And SpaceX has one of the most powerful narratives on Earth. Rockets, satellites, AI infrastructure, global internet, military technology, Mars colonization. Elon Musk. That combinations create a story so exciting that it pulls in billions of dollars almost magnetically. But here is the important counterpoint. And as an accountant channel, we have to say it clearly. Research from PitchBook, a firm that specifically tracks SpaceX, warns that post-IPO stocks historically underperform the market. Companies that build enormous hype before going public often see their share prices struggle once they are public and under constant scrutiny from financial regulators. The valuation of $1.75 trillion is, by any traditional accounting measure, extremely difficult to justify with today's numbers. It is a bet on a future that may or may not arrive on schedule, or at all. That does not mean the bet is wrong. Amazon looked impossible to justify in 1999, but it does mean investors should understand exactly what they are buying. Not today's reality, but tomorrow's possibility. So, what did we learn today? An IPO is not only about today's accounting numbers, it is about future expectations and the story investors believe. SpaceX may lose billions of dollars today, but investors believe it is positioning itself to dominate global internet, AI computing, military aerospace, and potentially the colonization of another planet. Modern financial markets are no longer driven only by profit, revenue, or accounting reports alone. They are driven by stories, And right now, SpaceX might be the biggest story in the world. The real question, and we want to hear your answer in the comments, is this: are investors funding the future of humanity or just the most expensive hype train ever created? Will you invest in SpaceX at this valuation? Let us know. Drop your answer in the comments. If this video helped you understand something complicated in simple terms, please like, subscribe, and share it with someone who needs to hear it. This is Accounting 123. See you in the next video.